Welcome to the deep dive. Today we are taking a really granular look at a high-stakes, multi-billion-dollar corporate deal. It's centered on Minnesota Power, but the real stake here is local control and, frankly, what you pay for your power bill every month.
Yeah, we're diving into this proposed $6.2 billion takeover of Allete, which is Minnesota Power's parent company. And we really want to explore why this seemingly regional utility deal has attracted, well, the world's biggest financial players, like BlackRock.
Right, and put them head-to-head with state regulators, consumer groups, even heavy industry up there.
So this deep dive, it's necessary because this is way more than just a local story about Duluth, Minnesota. Our goal for you, the listener, is to really understand the mechanics, like what happens when a giant global financial firm targets a local regulated monopoly.
We want to break down all the complex financial jargon, make it simple, and really get into the inherent tension here.
And that tension, it's pretty clear. It's Wall Street math versus public duty. Simple as that, almost.
On one side, you've got the buyers, this partnership led by BlackRock's Global Infrastructure Partners, or GIP. And, well, they're looking for really high investor returns. We know their fund, GIP Fund V, is explicitly targeting gross returns around, what, 15 to 20%?
Yeah, 15 to 20%. Now, put that in perspective. Your average publicly traded utility in the U.S., they're typically aiming for a return on equity in the high single digits. Think maybe 9.6, 9.8% recently.
So GIP's target is almost double that standard rate.
Almost double. And then on the other side, you have the utility's absolute public duty, provide affordable, reliable power to customers who, frankly, have no other choice. They're captive customers.
And the critics, including the administrative law judge who reviewed this whole thing, they argue those two goals, double-digit private returns and keeping bills affordable, are fundamentally, maybe even irreconcilably, opposed in this sector.
Exactly, which makes this acquisition a really crucial test case. We're seeing private equity trying to expand into essential infrastructure, water, hospitals, electricity, all across the U.S. This is kind of a proving ground.
Okay, so let's start unpacking the deal itself. Who are the key players involved in this $6.2 billion maneuver?
All right. The target company is Allete Inc. They're headquartered up in Duluth, Minnesota. It's an energy company, and its main business is regulated utilities.
Okay.
So that includes Minnesota Power, which serves, I think, over 150,000 residential and commercial customers across northern Minnesota.
Right.
Cold weather, heavy industrial base up there.
Right, big power users.
Yeah. And they also own Superior Water, Light and Power, or SWLMP, over in Wisconsin.
Mm-hmm.
And that industrial part is key because Minnesota Power serves these huge customers. Taconite mining, paper producers, they use massive amounts of electricity.
So Allete is basically the energy backbone for a really critical economic region. Now, who are the buyers? Because this is where the scale of global finance just jumps out. It's a partnership of two massive entities.
Right. That's right. First, you've got the Canada Pension Plan Investment Board, or CPP Investments. They're one of the world's largest pension fund managers, totally independent of the Canadian government, managing something like $590.8 billion in assets as of late last year. Huge.
Wow. So that's the long-term stable capital side.
Representing Canadian citizens' pensions, yeah. And the second partner is the real powerhouse here, Global Infrastructure Partners, or GIP.
GIP, I've heard a lot about them.
Yeah, they're one of the top infrastructure investors globally, managing $112 billion in assets. They specialize in these massive, complex, real assets, energy, transport, digital infrastructure, you name it. And the really significant thing, GIP was acquired by BlackRock last year.
Ah, okay. So that's the BlackRock connection.
That's the crucial global link. BlackRock, the world's largest asset manager, now effectively controls GIP. And in this specific deal structure, GIP is said to indirectly own 60% of Allete's.
Meaning the world's largest asset manager gets the controlling stake in Minnesota Power. Okay, so the transaction itself, it's valued at $6.2 billion, including assumed debt. And the buyers are paying $67 per share in cash. That sounds like a premium.
It was a pretty significant one, actually.
Yeah.
About 19.1% above Allete's share price right before the news broke last December.
Okay, let's use that Feynman approach here. Let's translate this Wall Street stuff into plain English. What exactly is a take private?
Good question. So Allete right now is a public company. Its shares trade on the New York Stock Exchange.
Right.
A take private means private investors, in this case, GIP and CPP, buy up all those outstanding shares, and then poof, the company is removed from the public stock exchange. It stops trading publicly.
Okay, so it's no longer listed. What's the immediate impact of that? Critics seem very focused on this.
Yeah, the immediate and really critical impact, according to pretty much every critic, is the loss of transparency. Mandated transparency.
Oh, so?
As a private entity, Allete won't have to file those detailed financial disclosures with the Securities and Exchange Commission, the SEC, anymore.
Ah, okay. So the public information that regulators, consumer advocates, even just regular ratepayers rely on to see costs, investments, internal finances.
So drastically reduced. Gone in
Yep.
many ways.
That definitely creates an information gap or asymmetry right off the bat. Okay, so why would Allete want to sell now? What's their stated reason?
Well, Allete, through their CEO, Bethany Owen, argues they need significant capital, big money. They want to fund their ambitious sustainability and action strategy.
Which is their clean energy plan.
Exactly. They're aiming for a really rapid clean energy transition, more solar, wind, storage, and they have to meet Minnesota's legal mandate to be 100% carbon-free by 2040. That's a huge lift.
It is lots of infrastructure needed.
Right. So they argue that going private shields them from, quote, volatile financial markets. It gives them stable, long-term access to the funds they need for these massive projects without worrying about quarterly earnings calls.
So the argument is basically the scale of the green transition needs deep-pocketed partners who think long-term, not quarter to quarter. Sounds plausible on the surface.
It does. But that brings us right back to the core financial mechanics of these regulated utilities. And this is why critics are so worried about, well, their electricity bills going up.
Right. This is where we need to simplify how a company like Minnesota Power actually makes money.
Exactly. Key piece of analysis here.
Okay, so Minnesota Power is a regulated monopoly. That means as a customer, you can't just switch providers if you don't like the price. You're captive.
Correct. And because of that, state and federal regulators like the Minnesota Public Utilities Commission, the MPUC, they set the rules. They're supposed to prevent price gouging, ensure fairness.
And the economics really hinge on two specific concepts, right? The rate base and the allowed return on equity, or ROE.
Those are the magic words. Let's break them down.
Okay, rate base first. What is it, simply put?
The rate base is basically the total dollar value of all the physical stuff the utility uses to serve you.
So the infrastructure.
Yeah, the power plants, the transmission lines, the substations, the poles, the wires running down your street, all of it. And crucially, this rate base number determines how much profit the utility can make, because regulators allow them to earn a return based on this number.
Okay, so the bigger the pile of assets, the more potential profit. Now, what about the allowed return on equity, the ROE?
That's the other side of the coin. The ROE is the specific percentage profit rate set by the regulator that the utility is guaranteed to earn each year on that rate base.
It's their guaranteed slice of profit.
Precisely. So if the MPUC says the ROE is, say, 9.65%, then the utility is legally guaranteed to earn 9.65% on the total value of all those assets in the rate base.
Okay, let's try that kitchen analogy again. How does that fit here?
Right, the kitchen analogy, think of the rate base as the kitchen itself. All the expensive ovens, mixers, pots, pans, everything you need to cook the food, which is electricity in this case.
Okay, the equipment. And we, the customers, are paying for that kitchen.
Essentially, yes, through your bills. Now, the allowed ROE, that's like the guaranteed profit margin the restaurant owner gets on every single dish they serve from that kitchen.
And the regulator, the MPUC, is like the health inspector or maybe the food critic, making sure the price on the menu, your bill, is fair for the ingredients used and the cost of that kitchen.
Exactly. They're the watchdog.
Okay, so if that profit margin, the ROE, is fixed by the regulator at, say, 9.65%, how do GIP and BlackRock plan to hit their much higher fund target of 15% to 20% returns? They can't just raise the percentage.
That is the absolute heart of the private equity threat, according to critics. If they can't easily raise the percentage profit margin, they are heavily incentivized to increase the total dollar amount of profit.
Ah, okay, so how do they do that?
They make the kitchen much, much bigger.
They maximize the rate base?
Precisely. They focus on aggressive capital spending. Building, upgrading, replacing assets, maybe even pushing projects that aren't strictly necessary right now because the larger that rate base grows.
The larger the absolute dollar amount of that guaranteed 9.65% profit becomes.
You got it. It's sometimes called gold plating the pipes. Making expensive investments that primarily serve to inflate the asset base, which, again, customers end up paying for over time.
And that must be hard for regulators to police, right? Telling the difference between a necessary grid upgrade and just padding the base.
Very difficult. It requires intense, ongoing scrutiny and technical expertise.
Okay, so maximizing the rate base is one way. What's the other way critics worry about for extracting value? You mentioned financial engineering and fee leakage. Let's break that down.
Right, fee leakage. This is where the parent company, GIP or BlackRock in this case, basically siphons cash out of the regulated utility, but outside of that official ROE profit formula.
Sneaky. How?
Well, there are a couple of main ways, usually involving affiliate transactions, deals between companies owned by the same parent. First, they could slap large management or consulting fees onto Minnesota Power for centralized services, things like IT support, legal help, management expertise provided by another company that BlackRock owns.
So Minnesota Power pays a sister company owned by BlackRock for services, potentially at an inflated non-market rate.
Potentially, yes.
Yeah.
And that cash immediately leaves the regulated utility, goes into the private owner's pocket, and helps hit that 15–20% return target.
Okay, that's one way. What's the second?
The second is directing Minnesota Power to sign expensive contracts, maybe for supplies, or construction projects with other companies affiliated with BlackRock or GIP.
So again, ensuring that the money paid by Minnesota Power's customers flows directly into the broader private fund structure.
Exactly. It keeps the money within the larger financial ecosystem, benefiting the private owners.
And we can't ignore the upfront cost of the deal itself. You mentioned that big premium paid to shareholders. Critics point out that premium somewhere between $600 million and $1.5 billion.
Yeah, a huge chunk of money.
That goes to the existing alleged shareholders and executives. But that cost, that value, is essentially loaded onto the newly private Allete, right? Often as debt.
That's the fear. While the regulations might ban recovering direct acquisition costs from customers for, say, 5 years, the utility now has this underlying debt burden from the premium.
Which puts pressure on management down the line.
Immense pressure. Pressure to aggressively grow that rate base or find those fee leakage routes to generate the cash needed to service the debt incurred from buying the company in the first place. And the captive customers. They inherit this financial pressure, but got zero benefit from the premium paid to sell the company.
Okay, that explains a lot about the opposition.
Yeah.
Which leads us to the next point. This deal faced remarkable pushback. You have this incredibly diverse coalition lined up against it. The Attorney General's office, environmental groups like the Sierra Club, even Minnesota Power's biggest industrial customers, the mines, the paper mills. What on earth unites that group?
It's a shared understanding of the risk, really. It boils down to the fear of seeing an essential monopoly service handed over to purely financial players who aren't primarily accountable to the public interest.
Makes sense. The industrial users, especially, must be terrified of rate hikes. They use so much power.
Absolutely. They see these new owners, with their high return targets, as a direct threat to their operating costs, their competitiveness, maybe even local jobs. But fundamentally, everyone in that coalition seems to agree. The standard private equity model, focused on hitting aggressive financial targets quickly, just inherently clashes with the public interest standard for a utility.
And the regulatory review process wasn't just a formality. We have to talk about the administrative law judge, Megan McKenzie. She reviewed all the evidence, public and non-public, and recommended outright rejection. That's strong.
Incredibly strong. Judge McKenzie's findings were, frankly, damning. She stated unequivocally that the private equity model isn't in the public interest here, because the risks just outweighed any promised benefits.
Did she cite specific reasons?
Yes. Crucially, she pointed to non-public evidence, internal planning documents from the buyers that showed they planned significant rate increases, well above inflation, and she noted an explicit intent to pursue profit in excess of public markets through company control.
Wow. So the internal plans didn't match the public statements.
That's exactly what it suggests, that the private internal goal was different from what was being presented during the regulatory process. That points to a fundamental breakdown of trust.
It implies the regulatory process, which kind of relies on good faith disclosure, was maybe being undermined by private intentions.
That's certainly the concern raised. And the opponents weren't just speculating about future harms. They brought up historical examples, concrete cases where private equity ownership of utilities led to sharp bill increases.
Right, you mentioned the UPPCO example in Michigan earlier. Let's revisit that.
Yeah, UPPCO, the Upper Peninsula Power Company, it was bought by private equity firms back in 2014. Since then, UPPCO customers have been hit with 4 separate bill hikes.
4 hikes. What was the result?
By the end of last year, their rates were a full 9 cents per kilowatt hour higher than the state average for other similar investor-owned utilities in Michigan.
9 cents higher. That's a huge difference for customers who have no other choice.
It's a major financial burden. directly linked to the change in ownership. It serves as a really stark warning, a cautionary tale for what could happen in Minnesota.
Okay, but the utility and the buyers, they keep saying this capital infusion is vital for the green transition, right? Meeting Minnesota's 2040 carbon-free goal. They argue the investment is necessary.
They do argue that. But again, critics, including the ALJ, found a significant risk that GIP might not actually prioritize the necessary clean energy investments.
Why the skepticism?
Well, they pointed out that Allete still has plans for fossil fuel spending specifically, converting its Big Boswell Energy Center from coal to run on natural gas and biomass.
So not fully clean.
Not fully clean. And maybe more damningly, GIP itself is a massive global investor in traditional fossil fuel infrastructure. They own stakes in things like a multi-billion-dollar liquefied natural gas LNG terminal down in South Texas.
So the concern is that GIP and BlackRock are ultimately committed to whatever provides the highest, quickest return. And if that means leveraging existing fossil fuel assets or maybe slowing down the clean transition because it's expensive up front.
Yeah. They'll do it, regardless of Minnesota's 2040 mandate, because their primary duty is to their fund investors, not Minnesota ratepayers. That's the core fear.
Okay, then there's the whole accountability issue. We talked about losing SEC transparency, but didn't the partnership also plan to keep control over budgets and debt?
Yeah, that's another key point. They plan to retain consent rights over budgets and debt decisions, giving them ultimate control over certain material actions. This is despite promising that local management, under CEO Bethany Owen, would remain independent.
So, if the private owners in New York or Toronto hold the veto power over the budget and major spending decisions, how independent is local management, really?
It raises serious questions about true local control. And adding to that concern, the ALJ specifically noted that during the review process, GIP and CPP Investments objected to numerous information requests from regulators. They provided heavily redacted documents or just didn't answer fully.
Making it hard to even vet the deal properly beforehand.
Exactly, and this leads us straight to a crucial knowledge gap that you, the listener, really need to think about. How enforceable are any regulatory commitments against these global financial giants?
Let's highlight that knowledge gap, we're asking. How effective can state-level regulators in Minnesota really be at monitoring and enforcing rules against massive, globally diversified firms like BlackRock GIT operating across dozens of countries?
Right. The fundamental problem is the mismatch in scale and resources and the limited tools regulators actually have. The MPUC, for instance, can impose penalties, but often they're quite small, maybe only $1,000 per violation in some cases.
$1,000. That's pocket change for these firms.
Pretty much. And regulators fundamentally lack the power to force specific capital investments if the company drags its feet. They can't dictate staffing levels beyond initial commitments, and they can't easily prevent dividends from being paid out, even if the utility is struggling financially.
So oversight is difficult.
Extremely. The ALJ warned that effective monitoring would need huge resources the Commission probably doesn't have, meaning violations might only be discovered after a violation and substantial harm had already occurred. And the lack of transparency from going private just makes that monitoring even harder.
Okay, so given the judge's recommendation to reject the deal and all these clear risks, what specific conditions or safeguards did the partners eventually offer to try and win approval from the commissions?
While facing all that opposition, they did make several significant commitments. They struck a settlement deal with the Minnesota Department of Commerce, for example, which then withdrew its opposition. These commitments are designed to offer some immediate ratepayer protection.
Okay, what are the key protections they offered?
First, there's a consumer protection package, a mandatory one-year freeze, a moratorium on any base rate increases. That's estimated to save customers about $25 million in that first year.
1 year freeze. What else?
Second, a strict 5-year ban on recovering any of those acquisition-related costs, that big premium we talked about, the $600 million to $1.5 billion. They can't pass those costs directly onto ratepayers for 5 years.
5 years.
Yeah.
Okay. What about tangible, longer-term benefits for customers?
They pledge $50 million. That money will be paid to Minnesota Power and eventually returned to customers as bill credits. But it's spread out until 2032.
Okay. $50 million by 2032. Anything else on the local front?
They also committed to keeping the headquarters in Duluth and honoring the existing union contracts and current workforce levels. But that workforce commitment is only for 2 years.
2 years. Okay. So, a package deal. Short-term rate freeze, longer-term bill credits, temporary job security. Now, what about protecting the actual financial health of the utility itself? That seems critical when a global financial firm takes over. This is where ring fencing comes in, right?
Exactly. Ring fencing is supposed to be a crucial safeguard. Let's
Hmm.
simplify that. Think of it like building a strong, secure firewall legally and financially around Minnesota Power.
A wall around its credit rating and its cash flow.
Precisely. To protect it from any financial risks, debts, or excessive fees coming from the parent company's global operations.
So the idea is, if GIP or BlackRock somehow gets into financial trouble elsewhere in the world, it shouldn't drag down the local Minnesota Power Company's ability to operate the grid or borrow money affordably.
That's the goal, to ensure the utility keeps its own independent investment-grade credit rating, which means stable borrowing costs, and to make sure the cash generated locally stays available for necessary local investments, not siphoned off inappropriately.
Okay, that sounds important. What other tools can regulators use to maintain control, especially over that fee leakage problem we discussed the affiliate transactions?
Affiliate transaction rules are key here. These rules require the utility, Minnesota Power, to get prior approval from the regulator before entering into deals with affiliated companies owned by BlackRock or GIP.
And they have to prove the prices are fair.
Yes, they had to demonstrate that the pricing is market-tested and competitive. This is the direct mechanism intended to stop the parent company from, say, overcharging the utility for shared IT services or management advice.
Okay, that seems like a decent framework on paper. But the skeptics, like the Attorney General's office, they were still warning these safeguards might not be enough, especially against a firm the size of BlackRock.
Their concerns centered on the duration of the protections and the sheer complexity of enforcement against a global giant. They warned that even that 5-year ban on recovering acquisition costs could potentially be bypassed
How? If they can't directly charge for the premium?
through something called vertical coordination. The idea is the new owners could direct Minnesota Power to sign really expensive, maybe long-term contracts with other companies that BlackRock owns globally, maybe for equipment or fuel or construction services.
Ah, so the cash leaves the utility over time through these intercompany deals, effectively getting around the direct cost recovery ban.
That's the worry. And it's incredible. Absolutely. You have to look at the massive shift in global finance that BlackRock's CEO, Larry Fink, has been talking about, especially in his recent letters to investors.
Right, he's been pushing this idea that the traditional investment portfolio is changing.
Dramatically. The classic 60% stocks, 40% bonds portfolio. Fink says that's becoming outdated for generating long-term returns, especially for big institutions like pension funds.
So what's the future portfolio structure he envisions?
He projects the new standard will shift towards something like 50% stocks, 30% bonds, and a significant 20% in private assets.
20% in private assets. What does that include?
Things like infrastructure, roads, airports, pipelines, power grids, also private credit, which is lending directly to companies, and private real estate. BlackRock is aggressively positioning itself to be the dominant player managing that huge 20% slice of the global investment pie. Acquiring GIP last year was the absolute cornerstone of that strategy.
Okay, let's use another analogy here to make this public versus private market shift clear.
Good idea. Think of the public markets, like the New York Stock Exchange, as a giant, well-lit, open-to-everyone restaurant. It requires detailed public reporting, like posting health inspection grades and listing all menu prices. Clearly, that's your SEC filings.
Okay, high transparency, open access.
Right. Now, the private markets, they're more like exclusive, members-only dinner parties. They offer potentially unique, high-yield investments, infrastructure funds, private company shares, but these assets are often illiquid, complex, and access is restricted mainly to big institutional investors or the very wealthy.
And transparency is low.
Extremely low.
Yeah.
Fink himself compared investing in private markets historically to trying to buy a house in a new city before Zillow existed. You just didn't have readily available comparable data. BlackRock's big push is to open up access, or at least manage access, to these private, potentially higher-yield assets for their massive client base, which includes huge pension funds like CPP investments.
And this shift is happening because the need for private investment is just enormous, right? Especially in infrastructure.
The scale is mind-boggling. Governments and banks simply don't have enough capital to fund all the necessary infrastructure upgrades and new projects worldwide. The projected demand globally is something like $68 trillion by 2040.
$68 trillion. That number is almost impossible to grasp.
To try and put it in perspective, that's like building the entire U.S. interstate highway system and the original transcontinental railroad combined every 6 weeks for the next 15 years straight.
Wow. Okay, so private capital has to step in, and BlackRock wants to be the main channel for that capital flow.
They want to be the indispensable manager, yes. And this infrastructure boom, particularly the demand for energy infrastructure, is getting turbocharged right now by the AI revolution.
Ah, the AI connection. Let's get specific here. How much power are we talking about?
It's staggering. Global electricity demand is surging, and these massive data centers needed for AI are the main drivers. A single, large, modern AI data center can consume 1 gigawatt of electricity.
1 gigawatt. How much is that?
That's enough power to run the entire city of Honolulu on its hottest day, just one data center. The demand for new power generation and, crucially, new transmission lines is absolutely exploding.
And BlackRock and GIP are positioning themselves to capitalize on this entire chain?
Vertically integrating, yes. GIP already owns stakes in over 40 data centers globally. And BlackRock has formed this AI infrastructure partnership with tech giants like NVIDIA and Microsoft.
So their strategy isn't just building data centers.
No, it's inserting themselves at every single point in the AI supply chain.
Mm.
They want to be involved in developing the data centers, financing the specialized hardware inside them, investing in the software companies, and this is key, owning the local power company, the utility like Minnesota Power, that provides the essential electricity and the transmission access to run it all.
Controlling the whole pipeline, from the power plant to the algorithm.
That seems to be the strategic aim.
But that level of strategic control raises some really profound social questions, maybe even national security questions. If building new power lines and generation takes years, you mentioned 13 years sometimes, for permitting in the U.S. and demand is soaring.
Society faces a really difficult trade-off.
A trade-off that BlackRock's CEO himself pointed out. Who gets the electricity, people or machines?
Exactly. If one entity has significant influence over both the power generation and the power-hungry data centers, they are potentially in a position to decide who gets prioritized when supply is tight. And remember, BlackRock's primary legal duty is to its investors' financial returns, not necessarily to the general public in Duluth or anywhere else.
Which brings us back full circle to why that regulated utility in Minnesota looks so attractive to them, despite its relatively small size on a global scale. It's that captive rate base we talked about.
It's the perfect private infrastructure asset from their perspective. Utilities offer incredibly stable, predictable, long-term cash flows. They're often inflation-linked.
And guaranteed by customers who have no choice but to pay their bills.
Right. Rain or shine, recession or boom, people need electricity. So they see the utility less as a local public service provider and more as a reliable, inflation-hedged financial asset that fits perfectly into that new 50% stocks, 30% bonds, 20% private assets portfolio model they're building for the long term. It's a utility acquisition, sure, but underneath, it's driven by a global portfolio maximization strategy.
Okay. So let's try to synthesize this. We've looked at the mechanics of this take-private utility sale. We've tried to demystify the economics, the rate base, the ROE, and we've placed this specific Minnesota fight into the much larger context of Wall Street's trillion-dollar push into private infrastructure, fueled heavily now by the AI boom.
Yeah, and what we've really seen are two very compelling but fundamentally contradictory narratives playing out. On one side, Allete and the buyers promise they're bringing the essential capital needed for the clean energy future. And they're offering immediate ratepayer benefits through those settlement agreements, the one-year freeze, the $50 million credit.
But on the other side, you have the critics. They're backed by that strong recommendation for rejection from the administrative law judge. They point to a private equity model with, apparently, documented internal plans to chase profits far above normal utility standards.
Profits likely achieved, they fear, through aggressive rate-based expansion or that kind of financial engineering and fee leakage we discussed. And the risk of future bill hikes isn't just theoretical. It's backed up by historical examples like UPPCO.
So the core battle seems to hinge entirely on whether you believe the promises of new capital for green energy outweigh the documented risks of prioritizing shareholder profit over public affordability and accountability.
That's the crux of it. And as you, the listener, think about this case and what it means for essential services everywhere, here are maybe 3 key knowledge gap questions worth exploring further.
Okay, first, even if state regulators impose strict conditions like ring fencing and rules on affiliate deals, how truly effective can that local oversight be against global giants like BlackRock? Can these massive firms use complex international structures and restricted data access to essentially sidestep state-level scrutiny over the long run?
Good question. Second, Given how critical energy infrastructure is becoming tied to AI, national security, everything should these essential services remain open to ownership by private equity firms,
Okay. Yeah.
especially firms whose business model often relies on shorter-term investment cycles, aiming for those very high returns, potentially forcing quicker, maybe riskier financial decisions at the utility level.
And finally, Larry Fink argues that bringing private assets into funds helps democratize investing, giving pension funds like CPP investments access to potentially higher returns. That sounds good. But does that push for higher investor returns through private ownership inherently conflict with the fundamental public goal of keeping essential utility service affordable and reliable, especially when that private ownership comes with less transparency and controlling interest in a monopoly?
These are tough questions with no easy answers. The final decision in the Minnesota Power case, whatever it turns out to be, will definitely set a precedent for how we handle ownership and regulation of essential services across the entire country. It's really a debate about whether the perceived benefits of private capital outweigh the potential costs of reduced public control and transparency.
So, the ultimate question, perhaps, for you, the person who flips the switch and pays the bill, is this. As our electricity grid becomes ever more critical, connected to every part of modern life, should the control over these essential local services remain locally accountable and transparent? Or is it inevitably destined to be influenced, or maybe even controlled, by the vast, often anonymous pools of long term capital driving this new global financial system? Something to think about.